Hey, what's up, guys? Brad here. So today I want to talk about the best index fund for 2020 on Robinhood, according to Warren Buffett. Now, unfortunately, I don't have a direct line for Warren Buffett, so I couldn't ask him personally what his favorite index fund is. But if you go to Dataroma, click on Warren Buffett, you can see the public companies that Berkshire Hathaway is holding. And this index fund is actually owned by Berkshire Hathaway. And the index fund is VOO, Vanguard S&P 500 ETF. Okay. Now, this is an ETF that aims to mirror the S&P 500 index. Okay. And it has a very low expense ratio. And that's critically important with these index funds. Because the fees, if the fees are large in these funds, it can have a real drag on performance. But the expense ratio for VOO is only 0.03%. So that's incredibly low. So why an index fund? Well, there's a lot of people who, first of all, aren't really interested in analyzing businesses. Okay. Another big reason is most people have a really hard time beating the market by investing in individual businesses. It's a difficult thing to do. So, even for people who want to devote a lot of time to the practice of investing, finding specific companies that may outperform the market over time, it's very difficult to actually do better than the S&P 500. So, for that reason, Warren Buffett recommends that most people invest this way in an index fund like VOO. Now, Joel Greenblatt, one of my favorite investing books, he wrote a book called The Little Book That Beats the Market. Now, in that book, Greenblatt comes out and says most people have no business investing in stocks on their own. Okay, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. Okay, that's what Joel Greenblatt has to say on the matter. So, VOO, Vanguard S&P 500, it has a 1.9% dividend yield. That's as of today. The dividend yields have been changing a lot recently because of, what's been happening with earnings for a lot of companies. They've been suspending their dividends. But anyway, right now, 1.9% dividend yield and 0.03% expense ratio. So I'm going to lay out kind of a framework for what I would do if I wanted to invest passively, okay? I don't want to analyze individual businesses, but I want to tether my financial future to the U.S. economy. I want to benefit by the growth of the U.S. stock market. So, step one, set up a Roth IRA, okay, a Roth individual retirement account. Now, unfortunately, Robinhood doesn't currently support Roth IRAs. I imagine they will soon, okay? Can't do that with Robinhood now. I have my Roth IRA through TD Ameritrade. The advantage of a Roth IRA is, so you pay taxes on your earnings, okay? And you put that post-tax money into your Roth IRA. Now, you never pay taxes on that investment account again. All of the dividends, all of the capital gains grow tax-free within that account. And then, if you withdraw those gains after 59 and a half years old, there's no penalty, okay? So that's the idea with a retirement account, is you're committing to leaving that money in there until retirement age. And I think that's an advantage as well for investors because, it's hard for us as investors to leave the money alone, to let that money grow over many, many years. But that's really the magic of compound growth, is to let your earnings, let your gains kind of grow on top of each other. That's that snowball effect, that eighth wonder of the world that Albert Einstein was talking about. So having it in a retirement account encourages us to leave it alone, to let it grow, okay? So I think that's a really important point. So that's step one, open a Roth IRA. Step two, find a low-fee index fund, ideally that tracks the S&P 500 index. That's what Buffett recommends. Find something that tracks the S&P 500. And that's VOO. So we've got that. We've got our index fund ETF. Step three, automate regular contributions. Okay, we really want this to be as automated as possible. We don't want to be making micro decisions in terms of our investment account. So, let's say you're making $50,000 a year. Ideally, you'd put, at a minimum, 10% of your earnings into your investment account. So that would be $5,000 per year. What is that per month? A little over $400 per month into this investment account automatically. So it goes from your bank account each month, boom, right into your Roth IRA account. And then you're going to set it up so it reinvests dividends. So if you've got, say, $10,000 in your retirement account right now in VOO, in this index fund that's paying about a 2% dividend yield, $10,000 every year, you're going to be making $200 in dividends. And you don't want that money just sitting there. You want that reinvested into VOO, okay? So you want to reinvest those dividends. And then I just want to give some figures. So say you invest $1,000 a year in VOO. Now the historical performance of the S&P 500, looking back about 50 years, is about 10% return per year, okay? So let's say every year you're putting $1,000 in. After 50 years, let's say you're starting at 25 years old, and you let this thing run for 50 years. So you don't touch it until you're 75, and each year you're putting $1,000 in. You're going to end up with $1.3 million, okay? So you've deposited about $51,000 over the course of 50 years, and now you have $1.3 million. So you're 25xing your contributions, okay? That's pretty good for really not doing anything, okay? All you've done is automatically invested in this index fund for 50 years. And instead of having $51,000 sitting in your bank account, which you would have if you were just saving it with no interest rate, instead of $51,000, you have $1.3 million, 25 times more. Now let's say instead of $1,000 per year, you're putting in $6,000 per year, which I believe is the current limit for a Roth IRA, $6,000 per year, which is $500 per month. It's not a crazy number. It's a lot for a lot of people, but I think for most people, you can find an extra $500 each month, or find a second or third income stream. Figure out how to generate an extra $500 a month, which is $6,000 per year. And then after 50 years, at a 10% rate of return in VOO, you've got 7.7 million, okay? 500 a month, 50 years, turns into $7.7 million. So this is really kind of a set it and forget it, just keep funneling a moderate amount of money into this thing each month, each quarter, each year, however you want to break it up. So, it's a really compelling situation here, guys, to kind of passively invest in the S&P 500. Now, I want to cover two more things. There's a lot of talk about there being a bubble in index funds, okay? Now, essentially what that means is because there's so much passive money flowing into index funds, the prices of the companies within those indexes have been pushed up, okay, as compared to companies that aren't in those indexes. Now, as a long-term investor, I don't think we really care about that because there's always going to be bubbles. Every 7 years on average, there's a stock market correction. But if you're investing consistently each year, $1,000, $5,000, whatever it is, sometimes the index is going to be high. Sometimes you're going to feel like it's in a bubble. The prices are higher than kind of what the underlying assets are worth. But other times, you're going to be investing right after there's been a correction or a dip. And so at those times, you're going to be buying when the underlying asset prices, when the price of the index is lower than kind of the underlying assets, okay? So sometimes you're going to be paying too much. Sometimes you're going to be getting a discount. And over the long term, over 10, 20, 30, 50 years, it's going to even out. Sometimes you're paying too much. Sometimes you're getting a discount, and it's going to even out. It doesn't really matter if these things are in a bubble in the short term. Now, the issue with a bubble in the short term is if you're putting a lump sum in all at once. Let's say you just got a big inheritance. You got a 6-figure inheritance. And you're like, well, I don't need this right now. I want to put this into my investment portfolio. The issue is if you put a lot of it, a big chunk of it in when you're kind of in that bubble territory where the prices are higher than they should be, what the underlying assets are actually worth, that's when you can get into trouble with bubbles. But if you're doing this consistent dollar cost averaging, putting the same amount in every month, every year, the bubble issue is kind of a non-issue, okay? So if I got a big inheritance, I might spread it out over 3 or 5 years, especially if I thought we were in a bit of a bubble territory. So 100,000, I might say, okay, I'm going to put 20,000 of that per year into VOO or whatever investment vehicle I'm interested in, just to kind of smooth out the volatility of what the market is doing. The last part, if you want to do better than the market, there's actually a way to do that, even with a passive investing approach like this. And it's a simple thing, and it's a thing that most people get completely in reverse. They do the opposite of what I'm going to suggest here. And the hack, I'm going to call it, is when the market is fearful, when people don't like stocks, when people are running away from the stock market, if you can up your contributions during those times, scrape together a little bit more money to throw into your investment portfolio, that's really going to help you. Because, at those times when people are running away from the stock market, pulling their money out, that's when prices are at the lowest. So that's when your investment dollars are going to go furthest, okay? And that's an important tip. And the thing that most people do is when they're doing this thing, they have the plan, they're investing a certain amount each month or each year. When something like a correction happens, they stop. They say, oh, I'm not going to put any more money in stocks right now because clearly it's unsafe. Clearly it's risky. Look at all these people running away from it. Look at the prices crashing down. But you guys got to remember, when the prices are crashing, I mean, there's still businesses behind those prices. And often the value of the businesses aren't dropping nearly as much as the prices, okay? Because, the stock market, it's an auction-driven market. So much of it is driven by fear and greed, human emotion, okay? So that's a really important thing for you to understand if you want kind of an easy hack to doing a little bit better than the market over time. When people are running away from the market, double down and up your contributions to your investment portfolio. That's the best tip I've got there. So anyway, guys, I just wanted to cover this. The best index fund, VOO. Find it in Robinhood. You can find it, I'm sure, at your brokerage. I highly recommend it for people who aren't interested in analyzing individual companies. So that's all I got, guys. Smash the thumbs up if you liked this video. Hit that subscribe button. I'm making a video every day. I think I'm on like day 69 today. The last 69 days, I've made a video every day to kind of help you guys improve your investing, to help me improve my investing, because by teaching you guys, by getting your feedback in the comments, I make myself a better investor as well. So that's all I got, guys. I will see you in the next video. Take care.